Fund accounting, it all starts with fund accounting. It's not fun accounting, it's fund accounting. And what fund accounting means, it's governmental accounting, and all the revenues and expenditures are going to be charged to a fund. You're going to have several funds and then departments inside of those funds. Y'all will be a department inside the general fund. But the easiest way to look at accounting in a governmental setting is checking accounts. Each fund is a checking account. Cash goes in, cash comes out of that checking account, and there's a balance. Everything's got a balance. So what I mean when I say balanced, you can't have any negative numbers. You always want some cash on hand, but you can't go negative with anything. So when we say you got to have balanced fund accounting, that means no negatives, no overdrafts in your checking account. There are three types of funds. You got governmental funds, proprietary funds, and fiduciary funds. Governmental funds, this is what's usually funded with the tax levy. This is what's going to be funded by your budget and what we're going to talk about with your tax levies a little later on today. But this is tax levies, some sales tax, some fees and things. General fund, that's police protection, fire protection, administration. That's what's in the general fund of a government. Special revenue, that's going to be special revenues. It's going to be grants, loan proceeds, bond proceeds, going to be accounted for in special revenue. Debt service is going to be, you put a levy on for debt service. You'll collect money to pay off any debts you might have, any bonds you might have out there when your debt payments are due. Capital projects, they're going to account for money that are going to build a building, build a park, build something like that. And then permanent funds. A lot of counties and municipalities, which this is going to be kind of geared towards, counties and municipalities don't have many permanent funds. You might. Where you find permanent funds is really 16th section funds in school districts. If you got a permanent fund, only the earnings out of that can be spent, not any of the principal. School districts have the majority of those inside the Mississippi governmental funds, or Mississippi governments. Special revenues. We get a lot of questions about, hey, can we spend this money on this? Hey, can we spend this money on this? So the important thing to know when you start asking questions what money can be spent on is where the money comes from. That's usually what restricts, it's the revenue side of money restricts what the expense side can be spent on. Can we spend this drug seizure money on this? Can we spend this on this? We're going to ask where that money came from, because that's going to tell us how you can spend that money. Proprietary funds, that's going to be more run like a business. Governments aren't run like a business. You're not in there to make money. You're there to break even. But you've got proprietary funds. What proprietary funds are, your water and your sewer, your garbage and sanitation, you charge a fee for the service you're providing. Since you are a monopoly, you cannot make money off of a proprietary fund. You've got to charge what it costs. So you're not supposed to be running your municipality or your county off of some kind of fee you're charging for a service that they got to have, because you got the monopoly. So in Mississippi government, proprietary funds don't make money, general funds don't make money. You're supposed to break even. We'll talk about that a little bit more. And then last one are fiduciary funds. There's some fiduciary funds, these are funds that are held in trust for somebody else. There's not a whole lot of fiduciary funds inside, but it's part of fund accounting, so we're just going to mention it. But there's not a whole lot in municipal government. We're going to talk about governmental revenues. You got different funding sources. You got local sources. That's what we're going to talk about today. We're going to talk about taxes and tax levies. You got state sources. That's when the legislature passes out some state revenue to you. Sales tax is one of those. You get a share of the sales tax. They collect it, but you get a share of it. Federal sources. You can have grants. Had a lot of grants that have come down because of COVID. And then 16th section sources. Those are mainly school districts. But those are where your revenue sources are coming from. Local revenue You got your property tax. That's the tax levy. That's what the budget is going to be concentrated on. The road and bridge, that's the tax levy counties really put on. License and commission, fines and forfeitures, that's fines and fees, intergovernmental shared revenues, charges for services, and interest income. That's really going to be your local, what your town, your county produces, those types of revenue. State revenue sources is going to be what's shared. State aid road funds for counties, homestead exemption reimbursement for counties and municipalities, gasoline tax, insurance rebate funds for fire insurance rebates, gas and oil and timber severance taxes, and truck and bus privilege tax. Those are taxes that are set by the legislature, that are collected at the state level, that are shared with the local governments. Federal sources, like I said, grants, loan, they have a gasoline tax, payment in lieu of taxes. So if you might have some federal lands that aren't taxable, you can't tax it in your county or municipality, but the federal government might have it in lieu of payment because they realize that they're taking land from you that they can't tax. So they might give you a little bit in lieu of paying tax. They give you some in lieu agreements. Those are going to be your sources of revenues. You got expenditures. This is what the checks you write out of those checkbooks to pay for any services that you provide. So all funds that are expended in a government must appear in a fund. Mississippi prohibits local governments from allowing expenses to exceed budgeted amounts. So personal liability can kick in for exceeding budgeted amounts. Since you can't exceed the budget, in essence, Mississippi law doesn't allow you to take something in the negative because you can't pass a budget that has any negative numbers in it. So that statement down there, you can't spend more than the board tells you can spend, and it's up to them to set a budget that makes sure they have the money to fund what they told you that you can spend. We'll get into that in a little more detail. I'm going through this pretty quick because I know nobody likes talking about accounting. So y'all ask questions if I'm going too fast. Fund balance, that's what's left over after all your revenues come in and all your expenses are paid. Just like your checkbook. You balance it, you got a little bit of money left over. You always need a little cash for cash flows issues. I said earlier that you're not supposed to make money. You're really not making money, but you got to build up a little bit of cash balance in there because you got to make it through the lean months. Governmental revenues don't come in 1/12 at a time. Not like a paycheck that's going to come in. When you get a paycheck, you know how much money is going to come in every month. You know what you can spend every month. Governments aren't like that. Most of their money, most of y'all's money, probably there's a little slide later on, probably 48%, 40, 45% are going to be property taxes that are going to roll in January and February. So majority of your money is going to come in then. So you got to keep that in mind when you're talking about a budget and you're talking about spending money. You got to make sure you budget to have a balance in there. So a lot of your new aldermen might come in and say, oh, we got a ton of money. If they've never been in government, they don't realize that money's got to make it through October, November, December, and probably half of January to pay payroll at least. So they're going to come in and think they got a lot of money. They don't. It's just the way the revenue rolls in. Had a phone call coming here today about somebody in trouble because they don't have very much money left and they got a long way to go before they get money coming in. So there's really not much you can do if you end up with zero balance at the end of the year. That being said, when fund balances begin to decrease and it's unexpected, then that usually indicates there's something negative going on. If it's unexpected, then somebody needs to look and somebody needs to pay attention what's happening. In turn, just because the fund balance is increasing, that might not be a positive thing either if it's unexpected. You're not supposed to tax your citizens for services that you're not providing today. So you're not supposed to make money to save for the future to build like a new jail, You're supposed to float a bond issue to build a jail, and the people paying for that bond issue to have that jail enjoy that jail. Well, maybe they don't enjoy it, but they enjoy having the jail. They probably wouldn't enjoy going to jail. Understanding tax in Mississippi. So to understand the budget process, you really got to understand the tax process. So what is ad valorem? It's Latin for meaning to the value or as to value. So ad valorem taxes are based on the value of an asset that you have. Everybody in the state pays tax based on the property you have, the cars you have, your personal property, businesses have. Unless it's exempt from taxes, you're paying tax on it. There are a list of exemptions, like usually your clothes, your personal property you own that is in your house, that's usually not going to have a value added. You're going to pay sales tax when you buy it, and you're done. But pretty much bigger type things, cars, buildings, homes, you're going to have that. It's going to be valued, and that's what your tax levy is going to be based on. So you're going to have to get your tax levy. It's going to be limited on how much you can bring in. You can only increase it 10% from year to year. So you got to use those tax levies for all the competing services that the city expects to have, your citizens expect to have. They want police protection, they want fire protection, they want good parks, they want whatever's out there that they see. There's limited resources, and you can't just tax everybody increasingly more than 10% a year. The law also says, and I don't have a slide on this, that it's the duty of the tax assessor who's at the county level to come up with the value of all the property that you own that's going to be taxed. It's the duty of the collector at the county level or the municipal level to collect those taxes, and it's the duty of every citizen to pay those taxes. So the board's authority is to set the budget and set the tax levy. We'll get into that a little bit more. In the tax process, there involves three main activities. You got the assessment of the property, the setting of the tax levy to apply to the assessed values, and the collecting of the taxes that result from those collections. So there's three processes. We're going to go over all three processes. What is assessed? The Constitution requires all property to be assessed. It shall be uniform and equal throughout the state. The Constitution sets the classes of property that we'll go over here on the next slide being taxed, and Mississippi Code sets the ratios applied to those taxes being taxed. These are the ratios. You got Class 1 property. That's most everybody's home. Single family, owner-occupied, residential. Class 1. It's 10% value or 10% ratio. Class 2. I like these definitions. All real property not classified as one. So that's all the other real property. That's all the other dirt. That's people's businesses. That's people's rental property. That's apartment complexes. That's duplexes. That's anything that's not a single family, owner-occupied, residential. You can think of Class 1 as homestead property when you file homestead. Class 2 is going to be everything else, real property. Class 3 is business property. If you have a business, it's going to be all your furniture, your fixtures, all your inventory, your equipment. That's personal property inside of a business. Class 4 is public utility property. Pipelines, telephone companies. Class 4 are those folks that really don't see that stuff. It's underground, but it has a value. And so that's public utilities. Class 5 are all your motor vehicles. You do pay, that's why tags in Mississippi are high, you do pay ad valorem tax on your vehicle when you get your tag every year, based on schedules from the Department of Revenue. The Department of Revenue has regulations on how to assess all these different classes of property and who collects the property tax and how it's divided up. The Department of Revenue adopts books and things like that that come up with how to assess property. So when you come down and you're saying, what's the value of the property? You got to come up with the value of the property. The value of the property is called the true value. That's where you start. And I like this definition too. The true value shall mean and include, but shall not be limited to, market value, cash value, actual value, property value, and value for the purpose of appraisal for ad valorem taxation. It is different than what your property is worth. It is what you're using that property for right now. So the use you're using that property for Class 1 and Class 2, the current use is what it's going to be appraised at. So if you go to the Delta, you got a farmer that sits right next to a casino, the casino's property is going to be valued higher than the agricultural use of the property of the farmer. So it's what you use it for. If you inherited your grandmama's house on the busiest intersection in town and you move into it, it's not going to be valued at what that's worth if you could stick a convenience store on it. If you keep it as a house, it's going to be valued as a house. You put a convenience store or something like that on it, then it's going to be valued at that current use of what you're using it for right then. So there's going to be a different, is what you're using the property for. It's going to be a different Class 1 and Class 2 property. There's two houses sitting beside each other that pay taxes on Class 1 and Class 2. If one's homestead Class 1, it's going to be a lot lower tax than Class 2, because if you'll see the formula that we'll go over here in a little bit, 10% gets applied to this true value, or 15% gets applied to it. So that increases the taxes. So you could have two houses side by side, somebody's paying more tax. That's why somebody's paying more tax. There's a snapshot taken for real property. It's going to be January 1 of each year. So as of January 1, you're going to get the true value of the property and who owns that property. That's why when you go to sell your house, you get a closing statement. You pay a little bit of taxes because you used it this year, and the buyer will pay a little bit of taxes because it's based on who owned it in January. So January 1 is when you determine when the value and who owns it. So you got to know who owns the property so you know who taxes the property. And that's when you map a county to the county. The assessor maps the county so he knows who owns all the property. He knows where all the buildings are inside the county and who he should send a tax bill to. So we kind of talked about this. True value and market value is not the same. You might have a higher market value based on what you use it for. Taxes, the snapshot's taken January 1 of this year, 2025, and it's payable on or before February 1st, 2026. You pay real property tax in arrears. You pay all the other classes, that's Class 1 and Class 2. You pay all the other class property taxes when they're due. You pay real property tax in arrears. Real property tax is really where the bulk of your money comes from. So what is assessed, or what is assessed value? That's the true value multiplied by that ratio. So if you get the true value multiplied by the ratio, that equals the assessed value. So you'll see the true value, when it gets multiplied, your assessed value is going to be a lot smaller than the value, or what you're paying your property tax on is going to be a lot less than the appraised value. The assessed value determines a whole lot of things inside of a county and a municipality, especially at the county level. Supervisor salaries are set on the assessed value of a county, and a lot of people's salaries are based off of supervisor salaries. So assessed values in counties does more than what you pay tax on. It also sets different salary levels. Also, the assessed value of your county is going to show how much revenue you can bring in, which is going to be how many services, how much service you can provide. You have tax rolls. You get assessments. Everybody gets assessed on Class 1 and Class 2 property. Those tax rolls are turned over to your supervisors. All the assessments done at the county level. It's turned over to your supervisors. It's turned over to your aldermen. The Board of Supervisors opens up the rolls for inspection. This is happening right now. If you don't like what your property's taxed for, you go to the supervisors during August and you appeal what your assessed value is. The Board of Supervisors makes the final decision. They're the only ones after July who can change an assessment on a piece of property. If you don't like that, then you can file in circuit court and say, hey, they didn't equitably appraise my property. I'm paying too much tax. So if you don't like the assessment, this is called equalizing the tax rolls. This is when you can file a complaint or go complain about your assessment, or anybody can. Part of the tax process is exemptions. So you get the assessed value. You get all these exemptions. So you can have exemptions, and there are three types of exemptions. You got regular exemption, special exemption, and special disabled veterans exemption. Regular exemption is for folks that are homeowners. Most people under 65 years of age, you can have up to $7,500 of your assessed value exempted. Under 75, and this is homestead exemption. This is what most people do. You got to file, and there's a schedule that says how much you get off your taxes based on the assessed value of your property. Same way with the special homestead exemption. Over 65, up to $7,500. So it sounds like the exact same thing as the regular homestead, but the regular homestead's based on a schedule is how much tax you get exempted from. But the special homestead, once you get 65, is exempts the $7,500 value before the tax gets applied. The last exception is going to be special homestead, totally disabled American veterans, or their unmarried surviving spouses, or any veteran or unmarried surviving spouse that have reached the age 90 years of age or older. They're exempt from all ad valorem taxes. So once you get the value, you get who owns it, you get how much value you have inside of your county or municipality, then you got to throw these exemptions in there. And you got three types of exemptions. We won't get into if the board has given an exemption to somebody else or a payment in lieu of. We won't get that detailed in it. But that's how you arrive at the value. So that's how you can determine how much money can I get, how much money do I have to spend. Homestead exemption for city taxes is only the special exemption. So the city doesn't have the exemption, the city's going to have the special exemption. Counties and school districts have the regular exemption. So there's a difference there. The state reimburses homestead exemption, $50 per application for counties in a school district, and $200 per application for special exemptions inside of a municipality. They send these checks out in March and September, so that's another check that comes that's not evenly 12 months. What is a mill? A mill is what levies are based on, and it's defined in the statutes. A mill is used in calculating money, but it is not even a piece of money. A dime is a tenth of a dollar. A penny is a hundredth of a dollar. A mill is a thousandth of a dollar. So a mill is written .001, and it's not even worth a penny. So your tax levy or your millage rate, however you want to refer to it, is stated in terms of mills, which is 1/1000th of a dollar, .001. So if you're calculating things, that's how you write the millage rate, .001. So if I had a mills of 25, to write it into a formula, I would have to move the decimal place over 3 places to get it stated correctly for the formula. So 25 mills would be written .025, because you got to move it over 3 places. So if you don't have that other zero out there, you got to add the zero. Most millage rates are probably in the triple digits anyway, but maybe not. Which gets us to the second activity, which is going to be kind of the budget process. The board has the authority to set the tax levy. The board has to decide based on how much revenue they need, based on the expenses that you're going to fill out and say, hey, this is what we want. They got to back into how much millage rate they need to set to bring in that revenue to get all the services they want to provide, to get all the police cars they want to buy, to get all the fire trucks they want to buy, any parks they want to do, any salaries for any department they want to pay. They got to go through, set the levy to produce the revenue that'll pay for all those things. Based on limits that are out there. The limits are going to be 10% annually for cities and counties and 4% for school districts. A lot of people don't realize this. Counties and cities put the millage rates on for school districts. When school district says, I need this much money to run my school district, Mr. City, Mr. County, then the city or the county has to put that levy on to produce that millage rate for that school district. It depends on if you have a municipal school district or just a county school district. School districts don't levy taxes. That's most people get mad at the supervisors or the aldermen for raising taxes. It's not always their fault. Fault might not be a good term to use, but it's not always. You have to put on the levy for the school districts. So brings us to the formula, or where you start. These are the different classes. The real property is class 1 and class 2. Personal property, class 3. Motor vehicles, class 4. Public utilities, 5. And mobile homes are going to be personal property or real property. It depends on some rules. We're not going to get deep into those rules. But if you own your own mobile home and it's on your land and the wheels are removed, it can be taxed as real property, which is beneficial when you look at the ratios you're applying to it. If you rent a spot to put a mobile home on, then it can't be. It's got to be personal property, which that percentage will go up. So this is what the assessor is going to give the board. They're going to say, our gross assessed value is 150. Your assessed value, that's what salaries, things like that, are going to be based on statutorily. But you got to take out the homestead exemptions, which gives you your net assessed value. Your net assessed value is what your levy is going to be applied to produce your revenue, assuming 100% collection. Like I said earlier, we had a slide. You can see your real property, 1 and 2, people's houses are a big portion of your tax levy. Now, depending on your municipality, you might get some sales tax that might be a little higher than other municipalities. Counties don't get sales tax. Counties do, and municipalities do get some use tax, which is new since 2008, which is some other revenue, but we're talking about how to set a levy and what your budget's based on. So that's what the board's got to look at to determine. I got $137 million that I got to put a levy against to produce the revenue from my expenses. So what will a mill generate? So if you got that net assessed value of $137 million and a mill's 0.001, you multiply them together, so 1 mill can produce $137,250 in some city, Mississippi. So how many mills, how many $137,000 do you need to cover everything inside your municipality? Plus any other revenue you got. We'll get into that when we get to the budget process. So that's what the board's got to do. They're setting that levy based on that number, and everybody wants more stuff. Everybody wants to pay more. Everybody wants newer equipment. Everybody wants new stuff. So that's what they got to do. That's what they're looking at. So that means if you follow the formula on down, assessed value times millage rate equal the budget. So budget divided by the assessed value is going to give you the millage rate you got to apply or you got to set. So that's when you back all the way up to budget, and they're going to ask you or somebody come up with what your office needs to run, your department needs to run. They're going to add up all those departments. They're going to put it into that budget number, and they're going to divide it by the assessed value, and they're going to come up with that tax levy, and then they're going to look at last year's tax levy and say, have we gone up more than 10%? And if we have, we got to go back and adjust some of these expenses inside this budget to bring down the number we need to stay within that 10% limit. Do we not want to raise taxes? Most people don't like raising taxes. It's hard to get reelected raising taxes. So if we don't want to raise taxes, then they might not be going up 10%. So then they got to go back to the departments and say, hey, we know everything costs more. We're not going to go up any, so you're going to have to cut some of your budget because cost of living, gas costs more, cars cost more, uniforms cost more. Everything costs more, but we're not going to raise taxes. So you got to come up with what you're going to cut or how you're going to justify us giving you all these resources when everybody wants those resources. So that's where they back into it. Gets back down to, you back into it from the expenditure side all the way up to what budget revenue do we need, and that's where they come. So if you assume a budget of $4 million divided by the assessed value, then you're going to have a millage rate of 29.1 mils, or inside that formula, you're going to have to move that decimal place back over this way to the right 3 places. So 29.1. So it's 29 mils. So broken down, that's how they back into it. The assumed budget is going to be all those wish lists, for lack of a better word, all those expenditures that you're coming up with to come up with that number. You add all that together and you're going to say, I got to produce this much revenue to provide everything that we want to provide. Or we got to find out in those expenditures what we want to cut so we can set our millage rate and not go up. That's what the board's got to figure out. Do they want to go up? Do they not want to go up? What else is going on? All right, so the city has determined that the gross value of the property is $150, the net assessed value is $120, and the city has a proposed budget of $20 million. So if you go back to that formula, gross doesn't mean anything except for salaries. Net is what you got to base it on, based on the revenue you want, and then you're going to come up .666, which is going to be 166.6 mils. Just you got to move it back over. So all that said, this is what people scream about. So the basic formula for Class 1 and Class 2, there's going to be a book for your cars. There's going to be a book for public utility that the Department of Revenue determines how much those people pay. The Department of Revenue sends a little book that gives the value of all your cars. That's how much ad valorem tax you pay on your cars. But the basic formula for real property, Class 1 and Class 2, is this basic formula. You got your true value, time your ratio, which is set by statute. That's at 10, 15, 30%. Times, they give you your assessed value. You multiply that by your millage rate. That's what the board sets. It gives you the gross tax that somebody's going to have to pay. So if you got a $65,000 house, true value, Class 2 property, and a tax millage rate of 48.5%, you're going to take $65,000, Class 2 is 15%, multiplied by 15, gives you $9,750, multiplied by the millage rate of 48.5, you move that decimal place over, 0.0485, you're going to have a tax bill of $472.88. So all that said, what you had to listen to thus far is fund accounting and basically the tax rate. Everybody pays taxes. Whatever that millage rate is set at, is going to affect every citizen in the county, every citizen in the city. Citizens in the city will pay county and city taxes. So when the board is arguing, discussing the budget, however you want to say, everybody is affected. Everybody living in that town is affected. That gets us to coming to talk about budgeting. We're going to go over terms. So when I say a term, you know, boards, kind of self-explanatory. It's a board of supervisors, aldermen, councilmen, depending on your form of government. Clerk, either chancery clerk or municipal clerk. We'll use that term interchangeable when we say clerk. Code is the code section in the Mississippi Code. Administrator means anybody charged with the operations of the county or municipal government. So administrator could be comptroller, administrator, could be the chancery and the city clerk. But so when I use that term, you'll know who I'm talking about. Departments, like I said, that's you guys. It's the street department, fire department, police department, city clerk's department, parks and recs department, sanitation. That's what we're talking about when we talk about department. The minutes, certain things have to happen in the minutes. Minutes are a permanent record of the actions taken by the boards. So we say if it's not in the minutes, it never happened. So minutes, when we say you got to adopt something on your minutes, you got to adopt it in an open meeting in the minutes. Tax assessor. We talked about him earlier when we were going over how you really collect taxes and things like that. Tax assessor is a person elected at the county level to value all the property inside the county, which includes a municipality. So municipalities don't have a tax assessor. They got a tax collector, but don't have a tax assessor. And then the tax levy. We spent enough time on the tax levy, what the tax levy means. That's what's applied to the value of the pieces of property. Year ends. All your year ends end on September the 30th. All is kind of a lie. Most cities and counties end on 9/30. You have some special charters that might end differently. Not many of those. Most year ends are statutorily set October 1 through September 30th. Counties and municipalities. To complicate things even further, like I said prior, you set levies for school districts. School districts' year ends run with the state. 6/30 year ends are the state and school districts. So school districts have to adopt a budget before they can open their doors, before you even before the county even puts the levy on. So it gets a little more complicated with the different year ends. But for the most part, everybody's year end is going to be September 30th. And that's what we're going to talk about now. If you got a different year and you got some questions about when things might need to happen when we start talking about public hearings and things like that, you're welcome to call us. You usually just got to back up from your year end and get the same time frame as to when you got to have budgets adopted by and tax levies put on. So, all that said, what's the importance of the budget? Well, the main thing is because state law requires it. State law requires everybody to adopt a cash basis budget and base their operations on a cash basis budget. Cash basis budget. Cash basis means money in, money out. Not supposed to save money, like we said prior. The budget determines what services you're going to provide to your citizens, and it's also a good idea to have a budget so you can tell people how you spent their money. Nobody wants to line up in line to come pay taxes. Nobody smiles when they come pay taxes. They don't want to pay taxes. So you're really forcing them to part with their money. So it's a good idea to be able to tell them what you did with their money, especially when it comes to election time. The purpose of the budget, it's an accounting document that records and controls expenditures. It's a management document. It determines who can spend and how much they can spend. It's a decision-making document. So you make sound decisions by the elected officials and the staff and appointed department heads. And there again, like we just said, it's communication. You're informing the public, or maybe investors, or maybe banks, how you're spending the money. So the users of a budget would be the public. For accountability, this is how you're taking care of my money. Departments, you can use it to plan with how much budget I got, how much can I spend, how much equipment can I buy, can I get new vehicles, when can I get new vehicles. And for legislature, grantors, you show them, hey, if you give me this grant for XYZ, I'm going to account for your money, I'm going to spend it right. Hey, legislature, if you help my county, my municipality out and give me money for XYZ, I am going to spend it on XYZ. I'm going to spend it right. I take care of the money that I'm in charge with. So that's the purposes of the budget. Counties, forms of government in a county, you got a unit and a beat. A unit is a countywide system of road administration. That means you got a road manager and a county administrator, and you work on the roads as a one unit. That's a unit. A beat. Beat counties don't have a road manager. Each beat operates as its own county business, so to speak. They do set the budget and do collect the money, and they spread it out to different beats however they choose to spread it out when they agree upon it in the board meeting. So if you get asked beat or unit if you're a county, that's the difference. Municipalities have a couple more forms of government. They got the mayor, board of aldermen. Most people refer to that as the code charter municipalities. That's probably 95, 97% of the municipalities in the state are code charter municipalities. They're different forms other than code charter: commission form, council manager form, mayor council form, and special charters. Some municipalities have special charters, and you got to see what form they fall under. The basic is, and not to put anybody down or anything like that, but mayor, board of aldermen, which is the majority of them, is a strong board, weak mayor form of government. The other ones just are different based on the different forms. But there are different forms. Budgeting process all follows the same process, but they're just different forms of government that are out there. All counties and municipalities adopt a budget, like I said, a cash basis budget. The budget's got to be balanced. And what we mean by balanced is you got beginning cash plus revenues minus expenditures equals ending cash. And none of those numbers can be negative. That's what we mean by balanced. So you adopt a balanced budget and you're required to stay within your budget. Therefore, municipalities, counties cannot overspend the revenue they got coming in if you follow the statutory scheme. We do have an ending cash because we got to make it through October, November, and December. Because your big money, like we talked about, is really coming in January and February. You have new boards that just walked in that might not understand that yet. But January, February is when the majority of most governments come in. Now, if you're in a municipality that's got lots of stores, lots of retail, you might have some sales tax that kicks in December, November for Christmas. But for the most part, majority of your money is probably coming in January and February. Budget. What you base your budget on, counties and municipalities, you have to budget revenue by type. So we went over the types of revenue. You got taxes, fees, fines, grants, and loans. You budget revenue by type. It can be in total when you adopt your budget. You got to adopt expenditures, what you're actually spending. You got to by fund, by department level, by purpose, or category, however you want to refer to that. What we mean by that is general fund, police department, personnel services, supplies, contractual services, capital outlay, debt service. Those are the categories. Those are the purposes that you adopted. We recommend that's the minimum level to adopt a budget. If you adopt it at the line level, or you adopt it more detailed, however you adopt it, or however the board adopts that budget, is what they are bound by, what you're bound by. Personal liability can kick in for exceeding the budget. So you don't want to exceed the budget. That's why we say you adopt it at this purpose level, this category level, because you know it's not going to be perfect, and you want to be able to operate and not have to keep calling special meetings, or the board keep calling special meetings to amend the budgets. Because for the most part, a budget can be amended at any time, except for municipalities. We'll talk about that later. Right now, they can't amend the budget for the first 3 months of a term. But other than that, you can amend the budget at any time. So all that said, we're going to talk about the budget calendar. We'll stay on this slide a little bit. This is the budget calendar. This is what we tell new boards what they need to follow. You'll look at the budget calendar. It's going to be on the next 2 slides, and you look at the months. So the budget process, even though you might have new boards that are actually going to set the budget, probably should have started sometime back in May. If you look when things have to be adopted, boards got to adopt a budget by 9/15. If you take that date and you work backwards on the things you got to do, you got to have public hearings. You got to have public hearings at a public meeting, not at a public meeting, but it's got to be a public meeting. You got to back up these things. You can't just call a public meeting tomorrow if you want to. It takes time to do these things. So you need to back up the calendar and build in delays. So in May-ish, the May-ish time, the board's going to set a policy. The board's going to look at what the policy says. You know, do we want to increase taxes? Do we not want to increase taxes? Do we expect the value of the property taxes to bring in more money? Is it a property reassessment year? What do we expect on the revenue side? For the most part, what do we expect on the expenditure side? Has anything happened that's going to cost us more expenses? Also during that time, somebody, a budget officer, chancery clerk, city clerk, somebody needs to come up with some financial projections. That is, when does the money roll in? Cash flows. You know, what kind of revenue are we expecting in October? What kind are we expecting in November? When is this money going to roll in so we know when we can tell people they can spend the money? June, they should come up with some kind of worksheet. And the worksheet should be given to the department heads, or maybe the chancery clerk or the city clerk, call the department head in, work through it. These are budget requests. These are forms you're going to put your budget request on. So in June and July, the departments are going to go through these budget requests and basically submit them to the board. And this is what I call the wish list sometimes. If things were perfect, this is what I wanted my department to get. This is what the raises I want to give. This is the new equipment I want to get. This is my wish list. In July, the board's going to take and review all the wish list. July, August, they're going to come up and develop a proposed budget and a proposed levy. So in municipalities right now, people came to work July 1, might be a new board, might be new mayors. Some of them might be a little shell-shocked right now because they got to have a budget, pretty much need a pretty decent budget come August because things are going to start happening. Because in August, you got to start advertising a public hearing for the budget and the tax levy. You got to advertise that public hearing for 2 weeks. So that's when it starts getting tricky, is in when you can adopt this budget. And this is what the boards are dealing with. In their August meeting, they got to hold a public hearing sometime in August on the budget and the tax levy and adopt a tax levy. So you got to hold a public hearing, you got to adopt a tax levy at that hearing, and cities have to adopt a budget a week later. Counties can adopt the budget on that date. Cities are supposed to adopt it a week later, which adds another week to the calendar. So if you start arguing or discussing, I guess is a better word, what you want to put in the budget, what expenses are in the budget, what levy I want to set, you're going to run out of time if you get much past August. You need to build in some delays. Your board needs to build in some delays. The next two things on here, September, between the 1st and the 15th, is the last day to approve/adopt a budget. It's September the 15th. It's the last day to publish or post the adopted tax levy. So by the 15th, you got to tell the tax collector what your levy is going to be, because car tags come October 1, he's got to have all those levies punched in to the computer system. So when he calculates a car tag October 1, he's collecting the right amount of taxes. So by the 15th, you got to have a levy adopted. You got to tell him what the levy is. By the 30th, that's your last day to publish a budget. You got to publish a budget at least once on September the 30th. Once you publish that budget, that's what you're telling the citizens. That's when we get back to this revenue by type and expenses by fund, department, category level. That's what we recommend, because that's what you're telling the citizens. That's what you got to live by. That's where personal liability kicks in. You can amend that budget at any time. September the 30th is the last day for a county to amend the current budget, the budget they're in right now. Cities can amend their budget up to October 30th of this year to amend their current budget. I say that they can't now because they're in their first term. They can't amend a budget in their first term of office unless revenues are not materializing. Which brings me to the next point. Down here, review budgets and actual reports. So the municipal clerk, chancery clerk, administrator, somebody needs to be doing a monthly report that's tracking your budget. You got to have what revenues have come in, year to date, what revenues remaining to come in, what expenses, based on how you adopted it, the monthly expenses, the month-to-date expenses, and the remaining balance to spend. That's monthly report that should be being done by somebody. So you can tell inside that, if you take that with your financial forecast, you can say, hey, was I expecting revenues to come in by now? Have they not come in by now? If they haven't come in, theoretically, if you follow the statutory scheme, when they adopted that budget, they said, Mr. Department Head, Mr. Police Chief, I'm giving you $300,000 to spend this year. So legally, you can incur $300,000 worth of expenses until they tell you you can't, because they've given you this budget. That's the way the budget laws are written. So you can spend $300,000. So somebody needs to be looking at this report, somebody needs to be making this report to make sure, if I've given you $300 to spend, but my revenue's not coming in, or $100 of that was a grant that we just got turned down for, I need to amend the budget to bring down the dollar amount that I told you you could spend, or it's on them for exceeding the budget. So you're not supposed to exceed the budget, because you might exceed the money you had, but they should have told you you had less money based on these reports. Is there any questions? I'm going through this way too fast, but is there any question about the budget calendar? I kind of want everybody to see what the board's dealing with and when you really need to start thinking about what your wish list is going to be, what you want to ask for, how you want to ask for it. When they adopt their policy, they need to understand what could go wrong, how it's going to happen, what's going to happen, and when it's going to go. So in May, like I said, they need to know the types of revenue that they got rolling in, when they expect it to roll in, and who's responsible for blowing the whistle when it's not there. Who's paying attention when it's not there? Hey, are they going to say, give that to the department heads? If they get that monthly budget, is that going to be the city clerk when she's doing that report? Because it's ultimately going to fall on them if they're not paying attention to it. And we hear a lot of them don't even really look at those monthly reports, but they're the ones that are supposed to be amending the budget and watching it. So that monthly report is just as important as having the budget adopted. Also, in the recent past, any additional costs that you didn't think about or wasn't there last year, COVID. When COVID hit, there were all kind of costs that were just popping out. You know, protective equipment, you know, gloves, hand sanitizer, you couldn't find it. So what additional costs when something happens, we got to look at the budget right now, start making an amendment, because we're going to run out of money. Now, I realize that you might not have to amend the budget to spend for emergencies, but if you spend it for emergencies, you don't have it for what you budgeted for. So you got to remember, if I'm spending this money for an emergency, I got to change something in my budget because I just didn't make more money. I just declared an emergency. So when something happens that wasn't in the budget, it's going to make you go adjust the budget. So make sure everybody's aware of that. It's kind of, we did this when we went over, you know, review budget request. So you, like I said earlier, you're giving the department head, you're giving them the ability to incur a liability. You're not supposed to incur a liability if you don't have a budget. If you don't have a budget by October 1st, theoretically, you're not supposed to incur a liability. So if you don't have a budget come October 1st, you're not supposed to turn the lights on. If you turn the lights on, you just incurred a liability. You're not supposed to incur a liability without a budget. So this is giving you the authority, getting a budget is giving you the authority to incur that liability. Sometimes in the past, the legislature, they were arguing over the budget this year, or discussing it, shouldn't say argue. But they had to have it done by year end, or we couldn't have come to work. So if you follow the scheme, that's the statutory scheme that Mississippi government is built on. You adopt the budget, you plan your budget on cash basis, and if you don't have a budget, you can't really come in there and open the doors because you just incurred a liability. Board's got to develop the proposed budget. Like I said, we've gone over this. They are solely responsible. They might get you to help, they might get other people to help, but they are solely responsible for adopting this budget. Like I said, we went over by revenue type, by department purpose or category, however you want to look at that. And liability kicks in at the lowest level adopted. So that's when you publish that budget, liability kicks in. You'll have a worksheet. You might have a worksheet that says Officer 1, 2, 3, 4, 5, 6, 7, this salary right here that adds up to a number that goes over there, and all the fringes that get added to it goes over there to that personnel category on your budget. Now, you might be going by this, but you adopted that. You know, there's going to be lots of backup, but it's what you adopt, or what you adopt in that meeting and what you tell the citizens. For personnel services, I'm going to spend this much. You might have a worksheet that's 100 pages long that total up to that dollar amount that you're looking at, but you're bound. Personal liability kicks in by whatever's adopted at that category level. And that's what we recommend, is the category level getting adopted. But that's when personal liability could kick in. Now, so we went over and we had all the budget calendars and stuff like that. But here's the kicker when it comes down to a budget. It's a hearing versus tax levy. There are a couple of statutes here. Municipalities have a statute that says they have to hold a public hearing 1 week prior to the adoption of a budget. They got to advertise in a newspaper, or if they've got a population under 1,500, they got to post it in 3 public places that, hey, we're having this public hearing to discuss the budget. A taxing entity, which changed several years ago, used to be a county. Now they changed the word county to taxing entity. It's a taxing entity, which a municipality is. Counties and municipalities are taxing entities. It requires advertising using specific language unless a municipality is less than 2,000 in population and is not increasing its tax levy. So it pretty much requires everybody to advertise now, unless it's under 2,000 and you're not increasing your tax levies. You have to adopt the levy on the date of that hearing or start the process over again. The hearing on the budget for the municipality or the tax levy in the budget must be 7 days before you adopt a budget, which adds another week to municipalities' budget adoption. So when you start looking at this and you're backing up that calendar, you hiccup in 1 or 2 of those hearings, you got to start it over again. You got to advertise. You just added 2 more weeks. So you got to get down to the point where at some point in time you got to adopt something, because you got to have it adopted by September 15th. So the advertising requirements, the municipal statute 2135.5, you got to have a public hearing 1 week prior to the adoption of the budget. Must have advance notice of the public hearing. Got to be held outside normal working hours, and there's no specific language in that one. So we recommend you combine it with the 2739.203, which means taxing entities, which are counties and municipalities, hold a public hearing to consider the budget and the tax levies. Like I said before, you got to advertise unless you're a municipality under 2,000 in population and you're not increasing your tax levy. So most people are going to have to advertise. The advertisement requirements. Like I said, the statute has the wording that you're supposed to use. I didn't put it in here because it's 2 different wordings. There's one wording if you're increasing your tax levy, and there's one wording if you're not increasing your tax levy. There's certain things you got to put in there if you're under a reassessment year, but there's got an exact wording you're supposed to put in there. You got to advertise, should not be less than 1/4 of the page, got to be 18-point font, got to have a 1-inch border around it, can't be placed in a newspaper where legal notices are. It's got to be in a paper of general circulation. General circulation means paid for circulation. The legislature's intent was it to appear in a newspaper published at least 5 days a week. That could add an expense. The advertisement shall run for 2 weeks, once a week for 2 weeks, which means you can't run it on a Monday and a Friday. You got to run it once a week for 2 weeks. Hearings got to be at least 7 days after the first advertisement. So you got to make sure it's got to run twice, and it's got to be 7 days after that first advertisement. And at this hearing, if you don't adopt a levy, then you got to start this whole process over again. So if you're somewhere that doesn't have a 5-day-a-week newspaper, and newspapers are getting harder and harder in some of the smaller type places, if you got one that's published once a week, making this fit gets pretty difficult if you miss that first date. If you're not thinking about September 15th and backing up the dates, you got to have a budget adopted by. In order to fit all these advertisements in, you could get in trouble quick. And people get in trouble every year because you got to have your budget adopted by September the 15th. You got to adopt it. You got to adopt the levy at this hearing. And then a municipality, don't forget, after this hearing date, you got to wait 7 days to adopt your budget. It's got to be adopted on the 15th. Counties can adopt the budget and the levy at this same meeting. Changing the budget. Like I said, budget can be changed at any time. There are budget amendments. If a municipality changes the budget that was adopted on the category level, hopefully you adopted a category level, by more than 10%, then you got to re-advertise the budget and say why you changed that budget. That's for a municipality. Also, just for a municipality, this year, budgets may only be revised one time during the first 3 months of a new term of office. And that is only because if your budgeted revenues are not materializing. So you can't make, if your budgets are rolling in and your revenues are coming in, you don't have the authority to amend your budget if you're a municipality until, well, right now, July, August, September. This is some additional information, Mississippi Code sections. If you go here, this is where you can find the code section. At the bottom of each code section that you look up, it'll have the last time it got amended. So this was in 2025. So if it says 2026 was the last time it got amended, then call that number at the bottom and say, hey, I'm looking at my budget. What got amended in this code section, so I'll make sure I'm doing everything the right way. You could call that 800 number. We're there to answer any questions about statutes, regulations, or whatever. We're here to help. So call us if you need us. Thank y'all.